Weekly Biz Show continues. Great to have you along. Todoroff, our executive producer, in studio with me today. Time to talk about gold. David Garofalo, we've had on the air before. He's the chairman and CEO of a company called Gold Royalty Corporation under the stock symbol GROY. GROY. And I think it's important to talk about gold as a macroeconomic and inflationary sort of discussion, but even more importantly, I want to spend a little bit of time exactly on what gold royalties do versus gold exploration, gold mining, because they are at the top of the food chain. I think we hit that just a little bit last time, but I want to start off with that. David, thanks for coming back on the program, sir.
Delighted to be here. Thanks for having me on.
Hey, talk about the royalty side of things versus the other. Again, I know we kind of tipped on that last time, but I want to spend a little bit of time with that today because you guys really are at the top of the sphere, top of the food chain here, and let's talk about why that works.
Yeah, I know for sure. I mean, operators take all of the risk. They put the capital in the ground. They have to manage the mine day to day, manage all the employees, take the operating cost risk. And that's particularly important in this inflationary environment that we find ourselves in. They not only give you the upside on the gold price, but they also expose you to operating cost inflation, capital cost inflation. Whereas a royalty company lends money to the operators and takes a royalty back in return on the top line, on the gross revenue. So we're completely insulated from operating costs and capital cost inflation at the mine site and give you optimum exposure, optimum leverage to the gold price.
Basically, you've taken your risk after the major risk has been taken on these mines. It's in terms of what's going to happen with gold prices is all you're really betting on. If gold prices go up and down, and based upon current inflation, which I say is understated at this point, I think there's a light at the end of the tunnel. But gold has always been thought of as a hedge against inflation. Some people agree, some people don't agree. But as far as price goes, price action always matches an inflationary picture. So you guys are in pretty good shape right now.
Yeah, absolutely. And if you look at the gold price, it is a very accurate barometer of underlying inflation in the economy. You just have to look at gold's performance over 50 years. Go back to when the U.S. government decoupled their currency from the gold standard in the early 1970s. And gold price went from $35 an ounce in the early 1970s to almost $2,100 an ounce today, whereas the purchasing power of the U.S. dollar has declined by over 90%. So it is a very accurate barometer over time to what's happening in terms of printing a fiat currency and the inflation effects on that currency's purchasing power.
David, I've got to ask you, because we had one other gold royalty company, which is a fantastic guest. It was Trey Wasser. I think you probably are familiar with Trey. And one of the things that Trey was always good at was telling him why his gold royalty company was better than the rest. We didn't get a chance to talk, but you guys are standouts. You really are. I joke about it, but in comparison to other royalty and streaming companies, talk about that.
Yeah, look, we have over 60% compounded annual growth in revenue right through the end of the decade. But more importantly, it's where that growth is coming from. We are concentrated in Nevada, Quebec, and Ontario, which are three of the top 5 jurisdictions in the world for low political risk, low regulatory risk, and also geological prospectivity. So we're exposed in the right geologies and the right political climates, so we don't have to worry about protecting the sanctity of our royalty contracts. We're in good countries with good legal frameworks. And so I think that's really an important distinguishing feature. But also we have royalties on 3 of the top 5 producing gold mines in North America. So we have scale as well. We have long life in our underlying assets. We have a foundational element to our story that'll be delivering royalty revenue for our shareholders for many decades to come. And we have diversification. We have over 240 royalties, principally focused on those 3 jurisdictions. And so we have diversification, which no operating company can hope to achieve. I mean, even running the biggest operating companies in the world, whether you're thinking of Newmont or Barrick, the most they can hope to manage is maybe a dozen assets. There's no limit to how much we can diversify, because at the end of the day, we're not managing mines, we're managing contracts. We're harvesting revenue from those mines, but we're not actually managing the mines. All that risk is housed within the operating companies.
David, talk about breaking into free cash flow in 2024. Is that a reality?
It is. In fact, we're looking at a doubling of our revenue this year versus last year. And as I said earlier on, we have very stable costs. We have a small human footprint. We have 8 full-time equivalent employees, and we could run a business 10 times the size with the same number of employees. So it's scalable with very low cost structure. And when we're at full production with all of our royalties, we're looking at north of a 90% margin on our business.
We got to get you to come down from the Great White North into San Diego at some point, pal. We'd love to have you in the studio. And again,
Delighted.
you're now officially our gold expert, David Garofalo, GROY. Thanks, David. Appreciate it. More Biz continues. Stand by.